Hey everybody. Okay, today we are talking about corporate governance. Now I'll have to get with you guys and find out how much you've actually covered this sort of thing in your law class. Then again, this may be a review because I know you took law a while ago. Now, as funny as this might sound, I actually find corporate governance fascinating. You may not find the same, but that is okay. That's why we're all a little bit different. Okay, so what exactly is corporate governance? Corporate governance is basically how we manage the relationship with our stakeholders to basically control the strategic direction and performance of a company, okay? So we have all these different kinds of mechanisms in place to manage that relationship. The stakeholders want to know that they are getting what they are expecting, okay? And so it's very important that these things are being put in place to make sure that the strategic plan that we have, that we've formulated, is going forward and that our organization is performing well. So how do we do that? We use both internal mechanisms and then external mechanisms. I'll talk about each one of these in detail, but essentially three big internal mechanisms: ownership concentration, executive compensation, board of directors. So it probably does not sound that exciting or that interesting, but it's actually quite interesting the way that it happens. Maybe I'm just a nerd like that, that's okay. And then of course we also have our external mechanisms, and that's things like market for corporate control, government does play a big part, and then corporate watchdogs. So I'll give you some ideas of all of those. So let's talk about ownership concentration first, okay? So the first thing that we're doing is that we are looking at basically who owns the shares. Now, in a lot of cases, I don't know how many of you actually invest or will at some point in time, but let's say that you buy, whatever, 100 shares of Kohl's, okay? Well, there's probably millions of shares of Kohl's. So your 100 shares of Kohl's does not count for a whole lot. However, let's say that we have somebody that owns, 20% of all of that million of Kohl's. So for every one share, you have one vote. So basically, you would have one vote, or you would have 100 votes for your 100 shares of Kohl's, and somebody that owns 200,000 shares of Kohl's, that person has 200,000 votes. So the thing is that we get a little bit worried because when we have a high percentage of shares in only the hands of a few investors, that means that those few investors have a lot more power, all right? And if you have a very large number of votes, that means you can really influence the way that management takes action, okay? So yeah, that's really what we're looking at. Now, if you have somebody that owns a lot of a particular company, this may actually represent a very large proportion of their wealth, and so as a result, they are probably going to be a lot more concerned than smaller shareholders about the decisions that managers are making and how and what is going on, okay? So for instance, I'll just give you myself as an example. I own shares in probably about 50 different companies. So if one of them does poorly, it's not the end of the world. But if I was to own shares in only two companies, I would be very concerned about those two companies, because if one of them does bad, then overall I'd lose half of my wealth in shares potentially. So this is really what we're talking about. So yeah, so in the end, higher ownership concentration leads to more active monitoring and more shareholder power to oversee management. And so that's really what we need to be concerned about. So now, this happens all the time. There are plenty of companies where one person or a handful of people own the vast majority of shares. This is not terribly uncommon, but again, it can really impact management activity because, these people are all voting members. So that's one part of it. The next part that we're concerned about is we're concerned about executive compensation. So basically the question is, how do we pay our top executives? So our CEO, our president, all of those sorts of people. Now, I'm not sure how familiar you are with this, but you guys should be. You should care how your CEO and how your top execs are being paid. It's important that you know this. Now, here's the deal. Very few company presidents, CEOs, the VPs, very few of them are paid only a salary. And the reason that we do not pay them only a salary is because if a greater proportion of their compensation is salary, then it really increases their risk aversion. Okay, there's no benefit. So the greater proportion of salary increases risk aversion. There's no benefit to take risk and put that salary at risk, because if the company performs poorly, then they get fired and they lose their salary, which is everything. So higher salary equals greater risk aversion. So that's why we typically have a salary. We give our CEO a bonus. So again, the bonus can be a question mark, because once a bonus is achieved, it reduces risk aversion. Okay, so let's say that they have to make so many sales, or they have to open a new property, whatever it may be, and then they get their bonus. Okay, well now we're not so concerned about what's going to happen, because we've already know that we're guaranteed to get that bonus. Other ways that we compensate our executives is through stock and stock options. So there's two different ways that stock is done, or shares. Sorry, that's the term that we use here. So shares or stock, there's unrestricted and restricted. Unrestricted means that you own those shares immediately. If I was the CEO, I could get my shares. I could cash them in tomorrow and do whatever I want with them if they are unrestricted. Restricted means that I now get those shares, I get that stock. However, I cannot use it until a specific date. So a lot of times it's a year or two down the road, or it may be until a particular target is met. So that basically means that if you leave before that target date, they're useless to you, okay? So again, as stock increases, risk aversion increases, because if the stock price declines, then managerial wealth declines. So again, they want to make sure that the company is doing well. Paying a CEO or an executive, at least in a small amount of stock, encourages some risk taking and encourages them to think like shareholders. Because again, they don't want to risk that. So paying CEOs in stock and shares makes them think like shareholders. And so again, they want to see that benefit. Stock options, again, that removes the downside of shares. They basically decide themselves whether or not they want to buy that stock. So it just gives them the option to do that. And then long-term incentive pay. So basically what long-term incentive pay is instead of giving an annual bonus, or instead of giving a bonus once a certain target is met, you give what's called long-term incentive pay. And so again, once they've been there so many years, or once they've achieved so many things, then they actually get cash. So it's just, one big check that they get. So instead of an annual bonus, it's like a multi-year bonus, if you will. So that is how we pay our CEOs and all of our executive team. And it's really important to kind of get the right balance for the right person. And a lot of times, a lot of negotiation goes into this when a new CEO or a new executive is being hired. So we're thinking about risk, we're thinking about how long we expect them to be there. So the nature of these different incentives does vary according to the different ones. Sometimes there are unintended consequences, but for the most part, if an executive is there to do well, as opposed to getting a golden parachute, we don't really give those out so much, but there have been times, particularly around like the global financial crisis, where, and leading up to that, where if a CEO is doing poorly, we would pay them to leave. So we would say, okay, we know you were supposed to be here for another 5 years. We know that you would have gotten these bonuses and that salary. We'll give it to you if you just go away quietly and get out of here because you're doing a lousy job, okay? But yeah, so the idea, we don't really give those out so much. But yeah, the idea is we want the right level of risk-seeking, but not too much risk. And so who is in part responsible for this? The biggest group responsible is what we call the board of directors. They have these 4 responsibilities. This is really what they do. So they determine what is the compensation for the CEO and the top management team. So they essentially determine how much those people are going to be paid, and as they are making those decisions, they are supposed to be representing the shareholder interests and really making sure that they're taking care of the shareholders and they're doing what makes sense. The shareholders are the owners. Even if it's just you and your 100 shares of Kohl's, you are still a part owner of Kohl's, and they want to make sure that your best interest is being taken to heart. So they set the compensation, they represent the shareholders and what they think that the shareholders want. In some cases, they're actually advising the CEO and the top management team on some management actions. However, to a large extent, the board of directors and the management team are pretty separate in the way that they operate. However, with the CEO and the CFO, the board of directors is looking at things like the financial reporting and then managing relationships with external auditors. So it's really important that they are always keeping above board when it comes to the money bit. So a couple of things I wanted to mention with regard to the board itself. So there's this duty of care. They're supposed to understand the business, know what it is that they're doing, and keep informed of ongoing activities. So it would be very embarrassing for a board member to, be at the pool with their kids and have somebody say, oh, I hear that they're doing X, Y, and Z over your company, and this person has no idea. So they're not briefed on day-to-day things, but they certainly know about big projects and strategy that's going to be happening. Secondly, we have this duty of loyalty. So they're supposed to be acting in the best interest of the corporation. And the corporation is congruent to, so alongside, but not necessarily identical to the shareholders, okay? So they do want to make sure that the shareholders are well taken care of, but ultimately they want to make sure that the corporation is performing well. I also wanted to bring up this. Sometimes you have, and I suggested that you go on and you look at a couple of boards to get an idea as to who serves on these boards. A lot of times it is CEOs, or former CEOs typically, or other bigwigs like, politicians or whatever. And sometimes it is other executive people from other companies. So for instance, Sheryl Sandberg, who is the COO of Facebook, Chief Operating Officer of Facebook, she is on the Disney board. So what happens when you have somebody who works for one company and is on the board of another company? It is very important, this is where this duty of loyalty comes in. It's very important that when you have a director who is also associated with another company, that they always take the conflict of interest is taken into account, and that the company for who she's on the board for is taken care of. So, okay, let me go back to the Sheryl Sandberg thing. So Sheryl Sandberg, she's at Facebook, but she's on the Disney board. Let's say that Facebook started to talk about, well, Facebook's not going to buy Disney. Let's say that Disney was going to buy Facebook, okay? She needs to make sure that she's representing the interests of Disney, not the interests of Facebook. So what she may actually have to do is step down from the board in order to not get involved in that, okay? Or she may have to do something else, okay? So she needs to make sure that she's representing, as a board member, the duty of the taking care of Disney, not taking care of Facebook. And in case you're wondering, she makes however many millions of dollars. So as a Disney board member, she makes about $200,000. Some of that is in a salary. Most of that is in stocks and shares. So again, these board members are very invested in making sure that the company for the board that they're on is doing well. Okay, I feel like that was a long-winded response. I'm sorry about that. Okay, and then we've got our business judgment rule. This is, again, basically protecting duty of care if it's ever questioned, making sure the directors are willing to take risks and do what makes sense. And then, of course, it does shield directors from any kind of liability in case the firm does yield bad results. Okay, so these are the internal bits. Now let's talk briefly about the external mechanisms. So we have these Market for control, market for corporate control is things like mergers and acquisitions, which we've talked about, and what we're doing in terms of takeover for underperformance. Now, in various different countries, there are laws in place that dictate who can take over, how it needs to occur, what kinds of taxes need to be paid, et cetera, et cetera. So, you know, and anyway, so that's part of this. But then also, in any time that we need to be replacing ineffective managers, activist investors, if you want to call it that, all of that is part of it. Government action and corporate watchdogs. So as I was starting to say, the government puts particular laws in place. They need to make sure that companies are complying with the laws that are there, to make sure that things like insider trading are not happening. There are also corporate watchdogs, which basically rate different companies based on how they're performing. So I want it in terms of corporate governance and compliance. So in terms of Australia, these are some of the big laws. So those first two are laws: the Trade Practices Act, the Prices Surveillance Act. So those are two laws that are in effect to make sure that ways that these types of things happen are legitimate. We have the Australian Competition and Commerce Commission, Australian Securities and Investment Commission, the Australian Securities Exchange. So of course that all has to do with selling and buying shares, and then Standards Australia. So there are several different organizations that are involved in this. I would have to say that everything that I've given you today is what you should know. Don't feel like you need to get into any more detail with these, but these are the basics. You should be relatively familiar with it. Any company that you go to, you should know who the top management team is, the exec team is. You should know who's on the board of directors, because those are potentially going to be impacting, even though you're going to be maybe a front desk manager or a hotel manager, you should know these things. Okay, so it's really important that you stay up to speed with what's going on, because this will ultimately determine a lot of strategy that your company is taking, the directions that they're going to be going in, what the future may potentially look for them, all of that. So make sure that you're up to speed, but I think that as a basis, this should be able to cover you for the future. Okay, thanks so much. See you next time.